Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be discussing whether or not you should be using stop loss orders for undefined risk option trading strategies. So that'd be things like if you are selling a Strangle or a Straddle, or if you're just selling a naked call or naked put by itself. If you're using those kinds of strategies, or if you are learning about them, then this video is for you. And if this stuff sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. I would greatly appreciate it. And so now quickly before we get started here, as always, if you would like to take some in-depth classes on options trading, and stock market investing, then check out my classes on SKILLSHARE. I've been teaching on that platform for well over a year at this point. And in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I have done using real stock market data with spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the SKILLSHARE platform if you do want to watch my courses. But if you do sign up for that membership using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on SKILLSHARE absolutely for free. And then once your trial is over, it will only cost you a few dollars a month to maintain your membership. And you'll gain access to all the future courses that I have planned going forward, in addition to all the other classes that are on SKILLSHARE too. And if you decide it's not for you, no worries, you can cancel before your trial is over and you won't lose a dime. But again, if you are interested, then check out those links below and join the thousands of other students that have already taken my classes. And so now with that being said, we're gonna hop over to my trading platform now and we'll get things started. Alrighty, welcome to my trading platform here, and this time we'll be taking a look at a 1-year price action chart of Lyft. I'm sure you've heard of it. And so I'm going to start this video off by just answering in a very simple fashion the question of whether or not you should be or should not be using stop loss orders for undefined risk strategies like Strangles or Straddles, naked calls, naked puts, etc. And so my answer to that question is no. And so now for the rest of this video, I'll be explaining why. And the first main reason has to do with the nature of using option selling as a core strategy. And specifically, I'm referring to the fact that when you do sell out of the money options, or even if you sell at the money options like a straddle, you are giving yourself a very high probability of making a profit on the trade. Option selling is inherently a high probability approach to options trading. So for example, if I was bullish on Lyft here, then what I could do is sell an out of the money put option with a strike price that is below where the stock is currently trading. So right now, Lyft is trading for around 64 bucks per share. And if we come over to the trade tab now, so I can see the option chain, and let's take a look at the April expiration cycle. So like I said, I could sell an out of the money put option here, and I might want to sell this one right here. This is the 55 strike put option. And looking at the bid and ask spread, I could sell this option for around 150 bucks or so. And so even though I am bullish on Lyft in this case, and I would like the stock to go higher, as long as by the expiration date, 40 days from today, as long as the stock stays above 55 bucks per share, this option will remain out of the money, it will expire worthless, and I will get to keep the full 150 bucks. So that means, of course, this stock at 64 currently could just go sideways until April 16th, or it could actually drop in price by almost a full $10, and I could still walk away with a full profit. So like I said, option selling is a high probability way of going about trading options. And that's one of the main reasons why I do it. And you can see right here with this percentage, this is the probability of this option being in the money, which you can see right here. That's what ITM stands for. And that's the same thing as the chance or the probability that Lyft falls below 55 bucks per share by the expiration date. And you can see there's only about a 25% chance of that happening, which means there's a 75% chance that by the expiration date, Lyft is still above 55 bucks per share. So a 75% chance that I will make a full 150 bucks on this trade. But the thing you must keep in mind here is these probabilities are based on the expiration date, which is still 40 days from today. So between now and then, anything could happen. The stock could go from 64 to 100, and that would be a great thing for me. Or it could totally plummet and go from 64 down to maybe 40 and blow way through my put strike here. But of course, if that did happen, if lift did fall down to 40 and there is still maybe 2 or 3 weeks left to go until the expiration date, that's plenty of time for the stock to recover. All that matters is by April 16th, lift is above 55 bucks per share. Anything can happen in between. And so that means if you do really want to take advantage of these high probability trades, then you should let these probabilities play out for as long as possible. And I can tell you from my own experience that the vast majority of the time, when your strikes do get tested, meaning in this case, if during this expiration cycle lift did fall below 55 bucks per share, most of the time by the expiration date the stock does eventually come back around and either ends up as a full winner or as a much smaller loss than where it was at the worst point. So again, just to reiterate here, letting these probabilities play out for as long as possible is, in my opinion, the best thing you can do. But if you had stop loss orders that would automatically take you out of trades once your losses hit a certain point, well, that might happen 3 weeks prior to the expiration date. And that definitely would not be allowing these probabilities to actually play out to their fullest potential. Now that being said, not everybody, myself included, has the luxury of allowing their naked option positions or their undefined risk positions to just let them go with very little management all the way until the expiration date, right? If lift did actually fall down to 40 bucks per share, maybe halfway through the expiration cycle, your losses at this point could be around $2,000. And if you only took in 150 for selling this put option, that's a huge loss to just maintain and hold on to for another few weeks. And it's definitely not always guaranteed that the stock actually will come back around and either end up as a full winner or a much smaller loss. Like I said, that generally does happen the majority of the time, but definitely not every time. And so what I do, for example, because I currently don't have the trading capital to just hold on to these kinds of positions forever, is there are ways you can adjust naked positions to slow the bleeding if things go wrong, so that you can hold on to the trades for as long as possible. I'll make more videos on adjustment techniques in the future, but one thing you can do in this case is if lift did blow through my put strike here, is I could sell also an out of the money call option against that, and that would, as I said, help slow the bleeding. I could also roll this contract out to the next expiration cycle and collect additional credit for doing that. I could also change strikes when doing that as well, so on and so forth. And again, I'll make separate videos on those topics in the future. But ultimately, even after making adjustments and doing what I can to hold on to these naked positions, sometimes the losses do just get too great, and I will just have to eventually cut my losses. But that being said, I will still not use a stop loss order to do that. And there are two main reasons why. The first of which has to do with the actual options markets. Specifically, usually in the morning when the market is just opening and trading is just starting to begin, oftentimes the difference between the bid and the ask spreads here can be very wide. So right now you can see the difference between the bid and the ask is very tight and narrow for most of these options, and this is generally what you want. But like I said, sometimes in the early morning, in the first few minutes of trading, this option, for example, might have a bid price of 100 and an asking price of 300. And that has the effect of often creating losses that aren't actually real. For example, when I check on some of my positions in the morning, in the first minute of trading, sometimes for a few positions that don't necessarily always have a lot of trading activity in the options markets, I might be down by 500 bucks, even though the stock hasn't moved at all from the previous day. And pretty much every time when I see that, I'll come into the option chain here, I'll check the bid and ask spread, and sure enough, for the next maybe 10 or 20 minutes or so, the bid and ask spreads are just super wide. But once trading really starts to get going, then these markets will start to tighten up. But if you did have stop loss orders in place, they could get triggered during that process. When the markets are super wide and you are technically down by a lot of money, just for a few minutes, like I said, that could still trigger your stop loss orders, and it is possible that you could get pulled out of a trade for a pretty nasty loss that would have been totally avoidable had you simply waited an extra 10 minutes or so. So that's the first main reason why I still would not use stop loss orders, even if I do have to cut losses at some point. The second main reason has to do with the pricing structure of options, and specifically I'm referring to implied volatility. And in case you're unaware, implied volatility is simply the market's expectation of where a stock like Lyft will be at some point in the future. It basically gives you an up or down price range of where Lyft will be trading either a week from now, a month from now, a year from now, etc. And this implied volatility, this expectation, is baked right into the prices of all the options. And in particular, as implied volatility expands, as the expected price range for Lyft gets wider, that's going to increase the prices of options. And then conversely, as implied volatility contracts, that's going to decrease the prices of options. And if I come to the charts here, and you look at this graph down here, and I'll actually expand it up a bit, there we go. This is a graph that depicts the implied volatility for Lyft over the past 1 year. And you can definitely see just how often it fluctuates and goes up and down on a daily basis. And so of course this means the prices of Lyft options are fluctuating up and down along with it. And this can all happen completely independent of where Lyft is actually trading, right? This stock could be going absolutely nowhere, but the implied volatility could be expanding or contracting for whatever reason. And so if we look at the USO chart now, USO, this is just an ETF that tracks crude oil in the US. And you can see back in April of 2020, the implied volatility for this ETF absolutely skyrocketed, right? If you may recall, back during this time, this is when the price of crude oil futures went below zero, which I believe was the first time in history that's ever happened. So of course, the market's expectation of what's going to happen to this crude oil ETF absolutely exploded and got out of control. And looking at the price chart here, you can see that when implied volatility was exploding, the price of USO was dropping pretty significantly. And I remember right around this point, this was when I started to sell out of the money put options on this ETF. I was both bullish on this ETF because it got to such a low price, and I knew the price of crude oil futures was not going to stay negative forever. And also I wanted to take advantage of the increased implied volatility levels that were drastically increasing the prices of those put options. But ultimately, after I sold those puts, the implied volatility kept expanding. And yes, the price of this ETF did continue a bit lower, but not by much. And even at this lowest point, the price of USO was still well above my put strikes. My puts were not even close to being tested, but because of the implied volatility expanded so much, that pushed the value of the options I sold well above the point where I actually sold them. So I was underwater by a significant amount of money. And in fact, my losses at this point actually exceeded my usual loss cutting point of around 3 times the credit I receive, which means, for example, if I sell a put for $100, 3 times that is 300. So if my losses exceed $300, I will generally close that position. Sometimes I might cut my losses a bit sooner, around 2.5 times the credit I receive, but definitely no more than 3 times. And that's also after making as many adjustments as possible to hold onto that position for as long as possible. So even at this point, when my losses did exceed my usual loss cutting point, I still held onto the trade because I knew my losses were simply a result of the implied volatility, not because the price of this ETF was actually really moving against me. In fact, it was hardly moving at all. And so sure enough, after a few more days, the implied volatility came way back down, and USO did recover pretty significantly, and I was able to get out of this trade for a full profit. But once again, if I had used stop loss orders, then I certainly would have been taken out of this trade for a pretty hefty loss for a really bad reason. So that's why ultimately, if I do need to eventually just get out of a trade for a loss, even after making as many adjustments as possible, I want to be the one who actually comes into my platform and places that order to get out manually. Because before I do that, I want to see why my losses are at the point that they are. If it's because the markets are just too wide at the moment, the bid and ask is just too wide, I'm going to wait. If implied volatility is getting out of control, but the stock price is nowhere near my option strikes, then I'm not going to get out of the trade. But your stop losses don't have any context around those things. They simply look at the price of the option, and if it hits a certain point, you're getting out of the trade. And lastly, before wrapping this video up, what I will do instead of using stop loss orders, because I definitely also don't want to just be watching my positions every second of every trading day, is I will set up alerts that will notify me, either ping my phone or ping my laptop here, to notify me when my losses on certain positions have hit certain points. And then I can come into my platform here and assess what's going on, figure out why my losses are the way they are, And then based on that, I can decide if I actually do need to get out and cut my losses, or if I can just continue holding on to the trade. So as a quick example, if you want to see that, let's go back to the trade tab here and take a look at the lift options once more. And so if I were to sell this 55 strike put option, and I wanted to get notified if my losses exceeded, let's say 3 times the price that I sold this option for, which is around 150, then I can just right click on this option, go to create alert. And so right now you can see the price of this option is right around 150. So losses of 3 times this would be 450 bucks, which means the price of this option would have to get to 600 for my losses to hit that point, right? Because if I sold it for 150, and if I do end up buying it back for 600, the difference there is 450, that would be my loss. So once I set this up, I would just hit create, and there you go. I have my alert set, and if lift does just really move down in price, or if implied volatility explodes, or sometimes if the bid and ask spreads just get super wide for whatever reason, this alert will get triggered. And like I said, I'll come into my platform afterwards, and I'll assess what's going on, and I'll react accordingly. Alright, so that's going to do it for this video. I hope you enjoyed it, and let me know in the comments below what you think about my explanation on whether or not you should be using stop loss orders for undefined risk strategies. Do you agree or disagree with me? I'm always happy to discuss, so let me know. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel, and make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.